Christian. So yeah, following up with the Phoenix, Palm Harbour, although I'm based in London in the grey. I like sunny places, so I named my fund after a sunny place. So it's actually named after Palm Harbour, Florida. Coming up with the name is difficult, so yeah, there you go. So we formed in 2018, although we launched our fund in 2019 because regulators are very slow. It's me. I have an analyst working for me, Konstantinos, and we're supported by our partner, Francisco Garcia Parames, who I guess most of you Spanish investors know. We launched about 4 years ago, in April. We've done about a 10% CAGR. We're heavily skewed towards Europe, as you can see on the map, although we are global. My background's in Europe. I know Europe's bread and butter, but when I find really attractive ideas, doesn't matter where in the world it is, attractive ideas are hard to find, so we go where we can. We're classical value investors. We want a big margin of safety. We want the highest quality company. We want high returns on tangible capital. We want good margins. We want growth runways, and we love cash. So we look at what has historically this company created in cash, and what does it look like 3, 5, 10 years out. We focus on competition, who can eat your lunch, and we want to make sure that the company is difficult to replicate. So we always ask ourselves, if we had unlimited capital, can I go and replicate this business quickly, or is it difficult? And we do a lot of primary research. We love talking to experts, finding the guy who's been in the industry for 30, 40 years. We like talking to suppliers, customers, competitors, whoever we can to understand the industry better. And then we invest when we think there's a significant discount. We're small, we focus on performance, not really big asset gatherers. We absolutely return focused, don't have a benchmark, don't look at benchmarks, don't look at indices. I have no idea. I'm trying to compound money for my clients. They don't, it doesn't matter if you outperformed or underperformed something. I'm trying to compound money in the mid-teens so you can buy a house, so you can retire well, so you can pay for your kids' education. So I'm totally agnostic. And then I have the majority of my wealth in the fund. Everybody working for me has money in the fund, and Parames has a significant stake. So we're going to start with a quick quiz. If you look at the EBITDA of this company from 2019 to 2022, you can see it had a nice COVID hit, but was able to maintain its margin pretty well. So what do you think happened to the shares? Well, the shares collapsed for COVID, rallied, and then collapsed again, despite the fact that it had the highest earnings that the company's ever had in the last 2 reporting halves. So this stock chart is RHI, which I pitched to Valuespain 2 years ago. I pitched it with the thesis that it's a refractory business. Refractories are basically bricks that are lining steel vats, go up to 2,000 degrees Celsius. They're consumables. They're only about 2% of the cost of making steel. They're recurring revenue because they get burned through, so you have to keep buying them. There's actually a bit of technology and stuff behind it. It's not just a commodity brick. It's actually something they have to do. And we thought RHI was the leader with pricing power, and that when bad times hit, they could actually adjust. And I think, and the market basically trades it like it's a cheap cyclical that's going bust soon. And I think we could demonstrate here that actually it's able to maintain its margin despite the fact that there's massive inflation in the world. They had supply chain issues. They had everything going against them, and their margin is about where it was before. And they were able to raise the prices. Volumes are flat for them in 2022, and they raised prices by 30%. So it seems to me it's a slightly higher quality company the market's willing to do for it, but as you can see on the graph there, I'm wrong by the market. So yeah, I just wanted to recap on that. To be fair, what's missing in this is that they've raised their inventory level, and so the cash flow has gone mostly to the working capital because of the supply chain issues, and they haven't unwound that. So the cash flows were not as good as the EBITDA might have suggested here. And I think that will eventually unwind, although they haven't indicated when that might be. So I'm going to pitch 2 stocks, and unfortunately had one of the best small cap French managers up here recently. But I'm going to go for a small cap French company anyways for my first one, LNA Santé. So LNA Santé, they nursing homes, medical centers, mostly psychiatric wards and day surgeries. They have 81 facilities, 10,000 beds, primarily in France, 4 facilities in Belgium, and they just started opening some in Poland. It's family run. We all have your views on families. I like them, on about 32%. Management owns a huge stake, and so do employees. We think there's high barrier to entries, not the highest in the world, but high, and that's because the French government hasn't issued any new licenses for nursing homes in the past over 10 years. And that's because the French state pays for part of the medical staff, medical equipment, and several other costs, and the French budget, well, they don't want to improve it at all. And in fact, the French state's been selling nursing homes, and that's the only real way to grow, is to buy a license from the state for one of their existing homes and upgrade the facility. We like it because there's demographic tailwinds. Everybody knows Europe's getting older, France is no exception, and the amount of population going into their sweet range of in the 80+ range is ever growing. And they make 20% returns on tangible capital. So you would think with all these qualities, they grow EBIT for the last 5 years at 10% CAGR, at 9% margin, growing top line at 10%. You'd think that this is probably trading at 20 times earnings or something. Well, the answer is no. As you can see on this chart here, the stock has collapsed about a year ago. And that's because of their nice large peer, Orpea. So Orpea, for those of you who haven't followed the situation whatsoever, was one of the largest nursing home companies in France. And Victor Cassanet, a French investigative journalist, came out with a book that took him 3 years to write. So one kind of questions why he didn't come faster if he thought so much bad things were happening, but there you go. He came out with a book, published it, called The Gravediggers. I would try to pronounce it in French, but I would just embarrass myself. And the book basically said these guys are committing all sorts of misappropriations of public money, fraudulent rebates from suppliers, fraudulent expensing of staff. Their facilities have low sanitary standards, possible allegations of tax evasion, bribery, you name it, they did it. It was all over the French press, big deal. Stock starts collapsing, management gets sacked, board gets sacked, complete everything. Get a new management team in. They basically said, well, we're being hit 2022, we're being hit by higher interest rates. They own a lot of real estate. They have very high LTVs, north of 60%. And inflation's hitting them. They can't raise tariffs quickly because you can't raise tariffs until your patient leaves the facility, dies. So you're being hit, your margin's collapsing, interest rates are going up, you have a lot of debt. Well, basically equity, zero. So what happens? Competitor Corian collapses. Competitor LNA Santé collapses. However, we think LNA Santé is not Orpea. They have a completely different real estate strategy. They have significantly less leverage. We believe their margins are more resilient and safer. We think they actually benefit as an incumbent to tougher regulation, and management actually welcomes it. We think that competition is now weak, and there's the possibility of even growing with some distressed M&A. It currently trades at a 12% free cash flow yield for a growing business that's been growing around 10% CAGR. We think that's pretty attractive. The company's buying back shares, management's been buying shares. And one other thing we like about it is, with some amazing luck, they did a capital increase just a few weeks closing before the Orpea broke out at $52.50 a share, in which 2,000 of their employees participated, of 7,000. So we think the family has an incentive to get the share price back up. Management has an incentive, but there's probably 2,000 employees who are a little bit disgruntled and probably want management to get the share price up too. So we think there's probably some incentive outside of just everything else for trying to get back to at least that level. So just quickly run through, like I said, they've been growing at a fairly good sales rate. The next 5 years we have 4% or 5% based on their announced pipeline, but that's not including M&A, which obviously is part of the growth driver. They already have a good occupancy rate. They've already recovered from COVID, which obviously gave them a dip. So it's pretty key to be 95% in France, because the French government they're subsidizing part of your costs of the medical staff, and if you're below that, they give you a lot less money. So Orpea is currently at 83 and Corian's at 88, so you can see where there might be some trouble there. And like I said, you go through license acquisitions and extensions. And then the margins, personnel cost is large. They've already negotiated 2023 tariffs. Both the government raises it with inflation, and they negotiate privately with the unions for the rest. They're actually hedged on energy, so they're not being affected by that. And management thinks that whatever they're being hit with, like the food costs, they're able to cut costs to maintain their margins. And I'll also note that there's about 9% margins, but that's because they're always upgrading beds and they're adding facilities. And similar to storage facilities, it takes a little time before you get up to what they call cruising speed. And so if you were to put and stop growing, the margin probably goes to 11-12% instead of 9%. But obviously they've been growing a lot, so they've never actually reached that, so that's all theoretical, but there you go. So why are they different from the real estate side? So they do have real estate debt, but they have a different strategy. They don't hold real estate on their balance sheet. What they do is they buy from the state or from a small operator. They then take their in-house development team. It's a 40-year-old facility run by the French state. They add lifts, elevators. They put in ensuite bathrooms. They make it standards where you actually want to be in it instead of a 40-year-old facility that have been upgraded. And then they sell it. And they don't sell it like possibly the aggressive other players did at huge premiums and try to make a quick buck today. They sell it basically at their cost. So the real estate division basically is break even. And they sell at their cost because they're locking in a 30-year or 15 plus 15 lease, and they're trying to keep their operating costs low. And they're trying to pay the lowest rent possible. Because they don't care about flipping real estate, they care about the next 30 years of their operating business. So they're locking in long-term leases at low rates as opposed to trying to flip properties and benefit from that. So if we look in the last, they haven't actually reported their full figures yet. It's a small French company. So last 12 months, they were at 1.7 times net debt to the operating business, and if you add the close to 200 million of real estate debt, they're at 3.8 times. So depending on how you want to account for that, that's up to you. For comparison, Orpea and Corian are around 4 times, 3.7 to 4, at the operating level. And if we get into what their real estate leverage is, you want to go into LTVs, it's 60%, but it's basically 14 times for Orpea, 15 times on the same metric that they're on at 3.8, and Corian's at 8.5 or something like that. So obviously very high. And then you start adding leases and stuff, it gets more complicated, but thanks to IFRS 16, it's all fun. But basically, they don't have any major financial issues whatsoever, and have plenty of cash and are buying back shares. So management obviously doesn't think, or the family doesn't think, that they're going to go bust very soon. So they have a different real estate approach. Obviously, the real estate values, like cap rates, are insane. It makes no sense where they're at. For nursing homes, you need 60% leverage to make anything make sense. So they're holding 200 million of or a little bit more than 200 million of real estate. Yeah, okay, but even if that all is worthless, which probably is not, they're still less than 4 times levered. So we think it's much safer than the 50% share of decline kind of indicates. So like I said, we have high occupancy, which is important. They're clearly benefiting from their competitors. When the French press says Orpea is a bad guy, do you go put your mom and dad in that facility? No. So you find a guy with a good reputation. Government's not incentivized to increase the authorizations. They have a strong pipeline, and like I said, there's distressed sellers in the market now, not only in France, but in Germany as well. There was a recent bankruptcy of a large player. So there's opportunities to acquire licenses. It's family controlled, which we like. Family increased their stake at 52.50, so did employees, so did management. Obviously, regulation is a swing factor. The management kind of likes more regulation, and it is, plenty of industries where, it protects incumbents. Clearly, if the thing to watch is if they start issuing new licenses to people. So that's the one clear risk. The other risk is reputation. We've talked to lots and lots of people, and everybody just says this is a stellar company. They're doing amazing things. There's one incident that we found where there was some disgruntled employees because they were closing a facility, but that's it. And yeah, like I said, we're talking to experts, and everybody thinks they're great. And I've never read the book. It's in French, but I believe the journalist even mentioned LNA as a good player as opposed to Orpea in the market in the book. And the other risk is there's a shortage of nurses and all those things that like there is everywhere in the developed world, and having to train and pay for them is an ongoing risk. So with that, this used to be a sexy sector. Everybody liked Orpea and Corian. Now it's an unloved sector. They used to trade at crazy multiples, 30 times EV, EBIT or whatever. They don't do that anymore. But we think for a company that has 20% returns on tangible capital, growing EBIT at 10% CAGR, 15, 20 times on a normalized free cash flow basis. On this we put 18, but you put whatever number you want on it, and we get over 100% upside on what should be a nice, boring nursing home business, more or less. And so we think our Orpea restructuring is behind us. Corian decides if they're going to restructure or what that's going to happen with their equity. When that's behind us, when these guys buy a couple of nice facilities from Orpea when they're on fire sale, and then these guys just show that they can keep growing and keep their margins, I think eventually re-rates at some point. And if not, they're buying back stock and it'll do something, or well, I believe that good things happen to companies that produce a lot of cash. So something good will happen. So that's my first one. I'm going to do another quick second one just because I thought that was a nice, simple idea and it didn't require too much. So my second one is Telekom Austria. This one's also quite basic and not very sexy. It's a leading telecom provider in Austria, where about 55-60% of their sales come from. They're also in Bulgaria, Croatia, Slovenia, Serbia, North Macedonia, which my Greek analyst doesn't let me say, but I'm saying it here. And of course, Belarus. We think it's well managed. The major shareholder is good friend, Mexican Carlos Slim and America Movil. And since he came in, they've radically changed the business. And it's trading at above a 12% free cash flow yield today, with over 25% returns on tangible capital. And unlike a lot of European telcos, it actually grows, because places like Austria grows 2-3%, but Bulgaria, Serbia, these places actually have growth, and they're still increasing penetration and everything. And these guys are number 1 or 2 player in most of their markets. They're all 3-player markets. They have a convergence in all markets with the exception of Serbia. So we like it. And the biggest kicker is they announced recently that they're going to spin off their tower business. And that's the second reason we like it, is the special sit angle. Reasons not to like it: it has relatively low liquidity. Austrian government's involved in it. It used to be an Austrian-owned, so they still have a bunch of state employees hanging around, costing them lots of money, that are slowly being wound off, but they're still there. And of course, Belarus exposure, 10% could disappear at any moment. So far, currency didn't collapse. They've been paying dividends. They're allowed to take money out of Belarus. They're not putting any money into Belarus, but that's clearly a risk that 10% disappears. Like I said, they've been growing, and there's all the reasons to believe they're still going to be able to grow with inflation, and a lot of their tariffs are linked to inflation. All their markets are oligopolistic, 3 players. Their biggest one, Austria, it's them, Deutsche Telekom, CK Hutchinson's 3 dry. They're big boys who don't really rock the boat, and they're not going to go and radically try to change market shares or anything. So obviously the threat of new entrants in their markets is one of the biggest risks, so you have one thing to monitor. And as you can see, the EBITDA margins here have improved steadily every year since Carlos Slim took over. They've been wringing out all the nice state costs that are in there, and as their employee base gets older, they get rid of all the state employees and they get non-state, ununionized employees, and that's been helping as well. And we think that's going to continue. So competition, relatively benign. Leverage, it's one of the lowest levered companies, telcos in Europe. It's just below 1 time levered. Generates lots of free cash flow, did 600 million free cash flow in 2022 after tons of growth capex. Shareholders mentioned you can be positive or negative on having Carlos Slim and the Austrian state in your shareholder base. Belarus, as I mentioned, and then there's the fiber, lots of telcos. People are like, oh, they have to spend lots of money, government mandates. Luckily, this has already been taken care of. The shareholders agreed that they're going to spend 1 billion over the next 10 years on fiber, which is already basically what they spend today, so it's not an additional amount of capex. The government agreed with them that you don't need to run fiber to every little mountain village in Austria, so they're not doing that. So what makes this particularly interesting is the tower business. So they've already announced that they're going to spin it off. We don't know anything about it, though. We know there's 12,000 towers they're considering spinning off, but we have no idea what they're doing with EBITDA, with what they're doing. We know nothing. So we all just can speculate. And we speculate by looking at past transactions, other listed peers, come up with a wide variety, because this has been a sexy area and people put all sorts of crazy multiples. But the theory is basically you have these telcos, you have a tower on a hill, there's 3 telco operators. Why make 3 towers on 3 separate hills? We can all just share one, and we all share the economics. But not everybody shares the economics. The tower company who has the tower on the hill shares the economics. And that's what they're working on. Cellnex did a deal just a couple years ago, buying Austrian towers from CK Hutchinson. Deutsche Telekom's done a deal as well. So these are the last guys of the 3 major ones in Austria. There's tons of deals that you look at. There's tons of EBITDA forecasts you can come up with per tower, but there is leases and non-leases, and it's very complicated to actually figure out. But anyways, we can come up with a range, 1.5 to 3.5 billion of value. Probably I'm using 2. I think that's pretty conservative, and it's not really necessary for the investment thesis of this. But basically, we think pre-spin, this thing's already ridiculously cheap. It's a 4.5 billion market cap, making 600 million of cash flow a year. Which we find attractive all in of itself. And like I said, it's a growing cash flow. It's not a shrinking cash flow. And they've already committed to what their capex is going to be, so it's not going to blow up on us. So I don't know why it trades at the current multiple, except for all telcos trade at low multiples. But as long as they're paying out nice dividends and doing other fun things, I think it's acceptable. But I think all by lonesome, without anything else, it's probably worth double what it is today. But we don't have to wait for that. We can get a spinoff. So I think they can spin off, as I mentioned, about 2 billion, so it's a 7 euro stock. I think the 2 billion tower spinoff is worth about 3 euros a share. So they're going to pay that out. If you adjust for the fact that they're going to move some debt to that, and they're going to move 50% of the leases on their leases are the lease rent is for towers, move that to the tower co. I don't think the free cash flow actually changes all that much. So you're not going to see, even if you move our estimated 150 to 250 million of EBITDA from the tower co to the tower co, the free cash flow, we don't believe it's actually going to change that much, because there's 90 million of rent being switched over as well, and some of the debt and interest payments. So you're still going to have your 100% upside on your boring old telco, but you get 3 euros of value in your tower spinoff as well. And then this thing will have about 0.6 times leverage when you're done with it. And I don't know about you, but 0.6 times on a telco doesn't make much sense. And governments like money, and so does Carlos Slim, I assume. So why not lever yourself up another billion, get yourself slightly above 2 or 1 times levered again, and pay out a special dividend of €1.50 a share. Makes sense to me. So yeah, if you think the telco could be worth double, you don't even really, just recently Liberty Global bought Telenet at like 6 times EV/EBITDA. This thing, X the towers goes is like 2.5 or something. So you don't need to use a huge imagination to think that maybe this is actually worth more. And then you get the tower co. And when you spin it off, who knows what it's going to be worth. 2 is probably reasonable, but over time, the other 2, Cellnex, there's going to be deals, and they're actually going to make the convergence and everything with the other players in the different markets. And I think it'll even be a growing 3 years on the spinoff that you get. So. Yeah, that's another idea I like, because not only do you have a boring telco, but at the end of this year, you're going to end up with a tower company, and Vantage Tower just got taken out. Rumors of American buying Cellnex, la la la. It's an area where the market's excited about. So there you go. So.
Okay, thank you. And a question? Please wait for the microphone, so the question also gets taped. Okay.
Hi. On LNA, I've seen that, are you not afraid of the 800 million debt? Well, I was checking their bonds. They have an outstanding bond. That's their cost of debt moved from 0% 1 year ago to 4% today. And as they don't own a lot of their real estate, don't you think they're too levered? Or that the current market cap is just reflecting this much higher cost of debt, while the EV actually didn't go that much down, went from 1.1 billion, 1.2 to 1.1, so the value of the company didn't actually decline significantly.
Okay, so you run those numbers run the number by me again? I don't have my cap structure in front
No,
of me.
I'm just saying that they have 800 million of debt, 300 million of market cap for such a
The 800
business.
million debt is primarily long-term leases. So
Okay.
that's IFRS 16 debt. So they don't have 800 million of
Okay, those are leases. Okay, but still,
Yeah,
nevertheless, the impact of the are you not afraid of the because they still pay a much higher interest on those leases?
No, the leases are locked. They're all they're like inflation escalators and a lot of the typical leases, but most of their debt is long-term leases. They have, like I said, 15, 30-year leases on nursing homes. So, yes, thank you IFRS 16 to make our lives more complicated as analysts, but depending on how you want to do that, you can say it is 4 times levered, or I think I have 4.5, including the leases. Yes, but I'm looking at I'm thinking of it as the operator. We have a cash out for rent. That's what they're paying every year. We have it going up because the rent will increase. There are usually inflation escalators and whatnot in them. So we take that into account to our future free cash flow numbers. But they don't have to refinance the leases. They don't have any of it. It's not an issue. They do have some bank debt which will go from 1% to 5%. And I use 5% normalized interest rates in all my models, even when they were 0. So I'm not really bothered by it too much.
Question here. So relating to the same company, how about the inflation risk? You mentioned that they're able to increase their rates with a negotiation process, but what if, let's say, the salaries go up fast and the negotiations get delayed, so they get squeezed with the profitability?
Yep, that's a risk. Once they have, so in the nursing home, there's half nursing homes and half psychiatric wards and day surgeries. Day surgeries, they can adjust prices, you know, whatever. Somebody comes in 2 weeks to have a foot surgery or something like that, not a problem. Nursing homes, when a resident comes in, they set a price and it doesn't change. So a person could be there 10 years and they're paying that. However, the average stay is below 2 years. So yes, you can be hit for a period of time, but there's quite high turnover. The average age is, I think, 87 or so. It's normally somebody who's close to being terminally ill, has Alzheimer's or other problems. And so, yeah, it's a high turnover, so the tariffs can be squeezed for a half year or a year, but it's not a long-term issue. Wages are always an issue. It's their largest cost by far. They negotiate them yearly. I think they raised them, 2.5% or something for 2023, so it wasn't a killer number. And the state pays for the expensive people, the doctors and everything, and they get automatically increased by whatever French CPI is, I think. So it's the janitors and the like and the catering staff and stuff that's their biggest cost. That's not automatically paid for by the government. But yeah, it's a risk. Management claims that they can offset it by other cost savings, et cetera, if it becomes a problem with the tariffs. But you can reset the tariffs. Like I said, it's less than 2 years. So again, I'm taking a 5-year view. I'm not worried about 1 year of inflation.
Anybody else? No? Thank you. Thank you so much, Peter.